Why 97% people fail in financial markets. Most people think markets are a math problem. They're not. It's a human psychology problem with a price chart attached. And that's why the scoreboard looks brutal, because the market doesn't reward intelligence. It rewards behavior under pressure. Most people never train that part, so they donate. The market is a mirror, and most people hate what they see. Here's the pattern you've seen 1,000 times. At $15,000 BTC, people were exhausted. Crypto is dead. It's over. I'm done. Near $100,000, the same people will be euphoric. Suddenly they believe in the tech again. Nothing changed about Bitcoin. Only their emotions did. Price doesn't create truth, but it creates permission. And most people wait for permission to act, which means they act late. 2. Why 97% lose. They trade feelings, not plans. Most retail traders operate on a simple system. Feel fear, wait, feel relief, chase, feel pain, panic, feel hope, average down, feel shame, disappear. Repeat, that's not a strategy. It's a nervous system reacting to flashing lights. The market loves that system because it turns humans into predictable liquidity. 3. The 81K lesson. People don't fear losing money, they fear being wrong. Let me show you how this looks in real time. Bitcoin at $81,000, people had extreme fear. They wanted certainty, so they said things like, I'll wait for 70,000. If it dumps, I'll buy lower. I need confirmation. Sounds responsible. But most of the time, it's just a socially acceptable way to say, I'm scared to press the button. Then the pump continues. Now they're watching price rise without them, and that's where the real emotion kicks in. Not fear of losing money, but fear of missing out. So what happens? They waited for 70,000, and then they buy higher because the pain of missing becomes bigger than the pain of risk. That's the trap market sets for you, but not for P-Circle. By God's grace, we had the guts to long at 81K levels publicly. Didn't let anyone chicken out on that opportunity. 4. Common traders need the crowd to agree with them. The 97% trader is allergic to being alone. They outsource confidence to X sentiment, YouTube thumbnails, group chats, analysts who never post entries, random influencers yelling, this is the top or this is the bottom. They don't want to be profitable. They want to be socially safe or share their trauma with familiar creators with the same loss. So they enter when it feels popular and exit when it feels embarrassing, which is basically buy when it's celebrated, sell when it's hated, congrats. You've invented the worst strategy on earth. Rare traders don't predict, they execute. The 3% trader doesn't need to be right. They need to be consistent. So their mind works in a different manner. Common, 97%. Trades to feel smart, needs to be right. Adds size when emotional, thinks in what if, stares at the chart for permission. Panics when volatility shows up. Changes the plan mid-trade. Measures success by one trade. Rare, 3%. Trades to follow process. Accepts being wrong. Sizes risk before the trade. Thinks in, then rules. Plan a trade, and then trade that plan expects volatility and plans for it. Updates the plan only at preset checkpoints. Measures success by 50 to 100 trades. One group trades identity, the other trades probabilities. 6. Designed for 97% to lose doesn't mean the market is evil. It means the environment amplifies human weaknesses. Leverage makes emotions louder. Volatility punishes hesitation. Noise creates false certainty. Social proof turns crowds into stampedes. And the chart is open 24/7, so your brain never rests. If you show up untrained, you'll do what humans do. Freeze, chase, panic, revenge, trade, repeat. The market doesn't have to beat you. You beat yourself. 7. The 3% protocol. Simple, not easy. If you want to stop being part of the herd, you need rules that run when your emotions fail. Here's the framework I drill into my people. Decide risk before entry. If you can't define where you're wrong, you're gambling. One plan, two outcomes. If it goes your way, then scale according to rules. If it goes against, then cut according to rules. No third option called hope. Reduce decisions during the trade. Most losses come from mid-trade improvisation. Trade less, review more. The market pays for discipline, not activity. Stop chasing perfect entries. Your job isn't to catch the bottom. Your job is to catch the move with controlled risk. Expect your brain to betray you, fear at lows. Greed at highs. This doesn't go away. You outtrain it. Build proof journal. Track, review, improve. Confidence must be earned. 8. The part nobody wants to hear. You don't rise to your goals in markets. You fall to your habits. And most people have habits built from Dopamine scrolling hot takes shortcuts, and the fantasy that one trade will change their life. That fantasy is why they over-leverage. Over-leverage is why they panic, and panic is why they become the 97%. 9. Where do we go from here? If you've ever felt fear at the lows, if you've ever chased because it's pumping without me, if you've ever closed a winning trade early, then watched it run, good. That means you're human. I had it once too. This is a learning path, and you can break through, but you won't break through by consuming more opinions. You break through by building a system that functions when you don't. I post consistent reminders inside Premium, and sometimes publicly for free, for one reason. So human psychology doesn't override your ability to act. The goal isn't to follow me forever, but to become the kind of person the market can't shake. That's how you join the top 3%. Thank you for the love and trust.